Good evening, everybody. Welcome to our 8 p.m. session, brought to you by Bursa Malaysia, right? For all your investing needs, all right? Welcome to our third episode for this year. Tonight, we're going to be talking about risk and reward, all right? If you guys can hear us well, can you just put a comment below to say that you can hear us, either you're on YouTube or Facebook? Tonight, it's going to be myself and Peter who will be hosting this session, right? So, Peter, welcome.
Yeah. Thanks for having me.
You are most welcome. Okay, so if you guys can hear us loud and clear, please just give us a comment below. That's really all we need. So I hope you guys are ready to learn. We have our third topic next every like we mentioned, every Saturday for the next 7 more Saturdays. We have sessions like this will be brought to you by Bursa Malaysia. These whole sessions are actually meant for education, right? To make sure you guys are a more informed investor. All right, let me just quickly share my screen. Let me see if I can present this. All right, so I hope you guys can see. Of course, if you stay till the end, all these slides are actually going to be made available to you. You're just going to wait till the end. We'll share a link to you guys, and you guys can actually go and download this link. All right. Hope you guys are doing well on a Saturday evening. I guess technically we are still in MCO, but if you've been walking around outside, it seems as though that's what what COVID, right? Okay.
What COVID?
Sorry.
What COVID?
Yeah. What COVID, right? Okay, so we're gonna get started. So today's session is gonna be an hour and a half long. Of course, we're gonna leave the last half an hour, 20 minutes for actually Q&A. So if you guys have any questions, please post it along the way, and myself and Peter will try our best to answer that question. All right, let's get some. Let's get some disclaimers out of the way. So this is going to be purely educational. And because we will be talking about stocks, this is by no means meant to be financial advice. Okay, so if you need financial advice, please speak to your financial advisor. Okay, so today we're really here to educate you, to teach you a little bit more about stocks. Hopefully, by the end of today, you are going to take away more than and made the 1.5 hours spent with us worthwhile. All right. Now, today we're going to talk about risk versus reward. So I'm going to run the first session, and then I'm going to hand it over to Peter, and then we're going to wrap it up for Q&A. All right. Now, if you remember episode 2, we talked about ETFs and REITs. So last week we spoke about ETFs and REITs. And really, this is just a refresher from what we covered last week. Most people perceive ETFs and REITs as lower risk. Okay. Of course, this snapshot really tells you what's the difference between a stock, an ETF, or a REIT, or even derivatives. These are the 4 main products provided by Bursa Malaysia. Basically, if you're investing in a stock, you are not investing in a ticker only. You are actually investing in a business, right? A business run by business managers. Okay, or like a better word, I call them business managers. The risk could be low, medium, or high. All right. When you talk about ETFs essentially will invest in either businesses or commodities or any other financial products, and these are run by fund managers. So your fund manager is running that. Okay. Again, it could be low, medium, or high. REITs are essentially property managers. So the whole idea of REIT stands for Real Estate Investment Trust. Essentially, they are a property manager that actually buys or sells or rents out property or manages it, right? And they give whatever income back to their unit holders, all right? And last, of course, is your derivatives. So anything that is derived from a mother share is known as a derivative, right? So the perceived volatility is high because of high volatility. Who manages it? You manage it ultimately. Okay, again, low, medium, high. It's very much going to depend on yourself. All right, how well you know the product, or how well you know the products, or the investment tool set that you're investing in. Okay, now just to get started, because we're going to be talking about risk versus reward, right? And the whole idea here is that we're going to delve into stocks this time. So second episode was about REITs and ETFs. So we're going to talk about stocks. I like to take this very popular quote from Warren Buffett. He says he only has 2 rules to investing. Number 1, don't lose money. He says number 2 is don't forget rule number 1. All right. In fact, some people have taken this and turned the whole business out from it. Just rule number 1, right? Don't lose money. And this is going to be the topic for today. So we're going to be talking about around this sort of this topic here. Now let's very quickly define risk. Where I think risk is such a casual word. You can Google it and you can find out what risk is. Okay, so I've got some questions here from Kid Boon. Where would you classify unit trust? Unit trust would be very similar to ETFs, except they're not traded on the exchange, but they are still funds, right? And they are also run by fund managers. All right. So again, it could be low, medium, high, because funds, you could invest in anything from bonds to just cash, or commodities, or overseas markets, or there's so many variations or themes around funds. So so really, the whole idea of what's the definition of risk, right? Without reading into the slide, it is effectively your chance of losing how much of your capital, or losing it completely. All right. What is a probability of you actually losing your capital when you put in investment? So any investment will carry risk. What is known as what they call a risk-free asset or risk-free rate is typically known as your fixed deposit. So if you go to finance school, normally they'll talk about risk-free rate. Risk-free rate is effectively what kind of rate you get if you put your money into a fixed deposit today. You're essentially guaranteed a return, right? So the moment you get yourself out from a risk-free environment, you automatically take risks, right? So imagine if you go to an ATM today and you withdraw, I don't know, $5,000, right? The moment that cash is with you, it'll also carry risk, right? So where you're gonna put it in, so any asset class I can think of actually will carry risk, right? And the whole idea here is that you want to get a higher return for the risk that you're taking. That's the whole idea. And of course, there's this concept thrown about called risk weighted returns. Okay, so a lot of people only look at returns; they actually don't look at risk, right? This is the whole idea why we want to talk about it, and really essentially how do you manage it. Now I think one of the first risks, if you talk about investing, is actually investment time horizon, and I'm talking risk specifically to retail individual investors like you and me, right? I see too often that people say, especially in the last few months when market has been quite hot, people come out and say, hey, I want to go into the market to kind of punt, right? And I don't think they even have this idea of time horizon, right? If I put my money into the stock market, I'm prepared to leave it there for at least 5 years, right? So the whole idea here is what can actually break your returns, and in fact make it even riskier is very simple, right? If you put money into stocks or any asset class that you need immediately, especially the less liquid it is, the higher of a discount you have to give, right? If you want money fast, right? And more often I see a lot of self-sabotaging happening. People put money in the stock market, and it's savings that they actually need to use, right? And the problem with this is that what happens is that if you put money in and suddenly you want to take it out, I can almost guarantee you from my own personal experience, it's where you need money most. It's where price is at the lowest. Okay, unfortunately, the universe is funny that way. But it's when you need money is when the stock price is at the lowest, right? So one of the risks that I want to get you guys to sort of eliminate or reduce is that, look, if you're going to put money into stocks, think about the time horizon, right? Because stocks are liquid, very, very liquid. right? But you don't want to put pressure on getting the capital out, okay? So which means that if you're investing in stocks over the long term, essentially what I'm trying to say is that you need to give it time to grow. You give your money some space to grow, right? You cannot keep pushing it very hard. Now, the second type of risk that will be different, right, will be definitely different asset classes. Okay, whether you decide to put in real estate, you put in stocks, you put it into bonds, whatever it is, different asset classes will give you different returns. And today we're actually going to be talking about returns and the risk that comes with it. All right. And of course, I think this is probably one of the most important ones that actually these are the risks that you can control, right? If you can control this risk, really ultimately what we're trying to do is actually reduce that risk that you can control first, right? So first is the asset class. You must understand the asset class they're in. You must understand there is a time horizon. So don't put money that needs to be used like in the next 6 months or your emergency funds, right? Probably not a good idea to put into stocks. Now, the third one is actually what is known as portfolio risk. Okay. Now, essentially, what it is, it's in your control. Is that again, where do I see people fail or succeed? It's actually very simple. They tend to over allocate their portfolio in a very high risk stock or stocks that they feel very, very strongly about. They tend to over allocate. Now, it's okay to over allocate, but you must understand what you're doing, right? And typically, it's not about just what you buy. I think you guys, we need to seriously think. It's not what you buy, it's also how much you buy of what. Okay. So that is a very, very important point. Okay, that means that I'm trying to eliminate the risk rate straight away for you, right? The ones that are in your control, right? The one not in your control, later Peter will cover that portion, right? So if you make sure you have a well enough diversified portfolio, right? I don't diversify for the sake of diversifying, but you must understand the business that you're in. But how much of what you buy or what you own in your portfolio is equally as important as what you put in your portfolio, right? Don't forget that's the second half of the equation. And to give you an example, how you want to limit some of your risks, right, is actually you may want to limit your exposure per stock, right? No matter how sexy it is, you say, look, maximum 10% or 15% of my portfolio, depending on the size of your portfolio, right? And say, look, that essentially will limit or manage that risk. Okay. The last one that you can actually do, and a lot of people don't do, well, except for you guys watching it here today, really is education, the skill, the experience, the managing of emotions. Ultimately, you are a very key part of that risk strategy that you are doing, right? You are involved in. What do I mean? I again, from my past experience, I see too often that people get very emotional about stocks, right? Especially when stock prices move up and down, right? And unfortunately, managing those emotions is not something that you can read a book and figure it out. Unfortunately, that doesn't work that way. But it's a very key point, right? To you succeeding and reducing that risk, right? Of course, education skills, at the end of the day, what I'm trying to say is you matter, right? You are either the biggest risk or the lowest risk in your portfolio returns today. If you're not, if you don't know what risk rate essentially comes from not knowing what you're doing, right? And as Buffett always says, never invest in a business that you cannot understand, right? And I think that is the central question to investing ultimately, right? The reason why I see some people go in and then when it goes up 10%, they sell, take profit, and then you see it go up, 15 times, and then you say, oh, I should have held longer. But the real central question to why that never happened is that you may not have a very strong sense of the business that you're investing in. In fact, if you're not investing, in my opinion, you are speculating. That means you're speculating that the price will go up or go down, right? So I think this is a very important part of investing that I think all of us need to align ourselves to, right? I mean, imagine if you are if you have no clue what you're doing and you decide to hop on a plane and sort of fly it, I can almost guarantee you that will end in disaster, right? So please arm yourself with education, and of course, Bursa is here sponsoring these events to hope to make you a more informed investor. All right. Now, okay, so when it comes to risk, I think there are two very broad-based risks that you have to look after yourself, right? Number one is actually called your capital at risk, okay? Which means that is your capital safe or not? How risky is your investment? Okay. The second risk that you have to manage is actually your timing risk. Okay. Now I'm going to give you two very extreme cases. If you find a good business to invest in, even if you had timed it wrong or you were wrong about the timing and that the risk is high, let's say if the price is very high and timing risk is high, if the business continues to grow over time, your capital at risk will still be intact. Yeah, of course, if you buy at a very high price, you may not make a lot of money. Okay, but essentially, you need to manage these two risks. And if you're an investor, ultimately your capital at risk, that means the business that you're investing in, is actually very important to you, right? Now, these are both very important items, but I'm not saying one is. I'm not saying that you need to ignore timing risk. That's not what I'm trying to say. I'm saying that timing risk is also a very, very a crucial ingredient in making sure you succeed, right? But here's the thing, right? When is the best time to buy, right? Who will ever know, right? And because you will never know, the whole idea here is that you want to spread that risk out, and therefore you have strategies around reducing your timing risk. Okay. Later I'll talk about capital risk. Now the thing about you picking that stock, that risk ends there. Okay. What happens to the stock after that is predominantly really realistically out of your control, right? Today we're just reading up. I think there's this big thing that's happening. A German company, top 30, it's in the index, right? It just got called out for fraud, right? That is essentially something that you will not be able to predict, right? But if you had limit your exposure in that stock, then you will limit that risk. Okay. So this is something that you want to make sure that there are several elements that you can look at to actually reduce that risk, right? And the whole idea here is that I think a lot of people just look at return, or can I make 10x, 20x, right? Without actually thinking about what kind of risk, additional risk you're taking, right? I rather take a lower risk for a lower return, in a sense. If you take a low risk, but this is why you call risk-weighted returns, right? I would prefer you take a lower risk, but still get very decent returns, okay? Rather than take a very high risk on something or business model that's not confirmed with the potential to make 100 times, okay? Now, I'm not saying that you will avoid both, but at the end of the day, that part is where you manage it with your portfolio allocation. Okay, now how is it that we define it here? What I've shown you here is actually the life cycle of a business. Okay, a typical life cycle. So if you look at very popular now, angel investing or seed investing or crowdfunding, right? Those are all really essentially where businesses first start, right? They're first starting. They may just have a minimum viable product. It's not being commercialized. You're not really sure on the growth. But yeah, if that company does succeed, they will make a lot of money, right? But of course, for a lot of startups that do start up, most of them will fail, right? So if I bring you through a sort of life cycle here on the screen, I'm saying that a lot of businesses start off as a startup, right? Eventually, when they hit that hedgehog effect that you got, you're going to move into this thing called emerging grade, then ultimately you go to investment grade. And that's really when you see companies that move and change in that profile, that's really where your money is also made as well, right? So at what level you go in, it's very much going to be determined on how much risk you are willing to take, right? If you look at this, if you find a very good company that starts up, if I can get a pointer here, they move from startup to emerging grade, ultimately investment grade. Okay, of course, they are big companies they don't keep up with times, they stop innovating, right? They get a bit lazy. Typically what happens then, they move into a sunset business. Ultimately, if they fail and you get a new management, new capital injection, new business model, it may turn around. Okay, but if you look at in terms of the risk profile, each of these stages of your business actually carry different types of risks. Different, okay? In a nutshell. Now, the whole idea here, why I'm showing you guys this, is that I want investors to start thinking about what is the percentage, right? However you classify this, right? You can call it low, medium, high risk, for example. How much of your investment is actually in something that is high risk, right? And that risk profile is something only you can decide on, right? It depends on how much you understand the business, right? Or the business model or the market dynamics and so on and so forth, right? So if you look at these 6 categories of stocks, ultimately what I'm trying to tell you is that part of your portfolio allocation, you must determine whether it's low, medium, high, or extremely high. Okay, and one of the things that you can do, right, in your portfolio today, you want to look at it. Look, how many percent of this will? Let's say I got 10 stocks. I'm going to figure out each stock equals to what weightage in my portfolio, and then if I can sort of grade them myself and look at the risk, you actually get a very clear indication on the portfolio that you're in, right? I mean, if you say, look, I'm limiting myself to 10% allocation for risky stock, I cannot buy 10 risky stocks to say that, yeah, I've diversified it away, right? I don't believe that happens, right? The whole idea here is that you want to have a combination of investment grade, emerging, or startup, also turnaround in your portfolio, all right? And the whole idea here is to look at your risk profile. Are you maybe the problem with risk is the other way around, right? So I see a lot of people who are very conservative, so they only buy very, very, very low risk kind of stocks, but they are expecting very high return. So what I'm trying to bridge you in this session today is that I'm trying to bridge that expectation as well, right? A very, very large company that's already grown and they've been in business for a long time, and the business is working, that's probably growing at 5% a year. They're unlikely to give you a 10-time return in the next 3 years. Okay, just to give you an idea. So it's really about managing that expectation of return ultimately. All right. So actually, I have some case studies here which I just want to share. And the whole purpose of sharing some of this is to give you an idea. When I talk about startup, emerging grade, investment grade, sunset, or turnaround, any of these 6 categories of stocks, I just want to give you a sense of what kind of returns you may be looking at. Okay, just a sense of returns. Okay. Now, if you look at, so I'm going to show some very famous stocks that I think everyone knows about, and I just want to give you a comparative study very quickly, right? So what I did was, I think if you guys have heard, if you can go to Google FANG, I think it's a very popular, how do I say? It's a very popular acronym or abbreviation, right? It's a very popular abbreviation. What it stand for? Of course, it's been extended over time. Originally, I think it only stood for Facebook, Apple, Amazon, Netflix, and Google, right? I think now it's included NVIDIA. FANG, Tesla is also part of FANG as well, right? It's actually to represent tech giants, right? So if you look at my episode 2, can you actually buy, can you have exposure to FANG stocks through Bursa Malaysia? You can actually do it through the ETF, which is provided by Trade Plus, where you can actually long or you can also short FANG stocks. So they track the FANG Plus index, which is run by the New York Stock Exchange, right? So even on Bursa Malaysia, you can still get exposure to these stocks if you like them, right? Now, these are all global brand names. Likely you guys are all already customers or you use their products, right? These are all global businesses, very big companies. So one of the things that we did was I'm not sure if this is big enough. I hope you guys can see. If not, let me try and increase the font size a little bit, yeah. So you guys can see. let me just try and increase the font size. I realize that it may not be big enough. Okay. Okay, I'm just going to increase the font size. Okay, so I'm going to give you guys some very interesting IPO returns. There we go. So I hope this is something you guys can see. Eddie's saying that the screen is a bit blur. So I'm going to max it out so you guys can really see, okay? Now, so this is quite interesting. So I took out some very popular stocks, I'll like call it, right? A lot of investors like these stocks. And I actually looked at their returns, right? What kind of returns would you have gotten if you had bought at the IPO price or at the closing on the first day, right? So like you say, Facebook, Amazon, Apple, Netflix, Tesla, and NVIDIA. If you're not familiar with this, you can go and Google them. NVIDIA makes all the graphical processing units, for gamers and a lot of other things. Now it's got a lot of applications in artificial intelligence as well. If you look at these returns, and these are all IPO'd at different times. Okay, Apple being the oldest company that has been listed. This is as of 26th of June 2020, right? So Apple was listed in the 80s, right? 1981, I believe. Okay, you can look at their returns. Facebook in 8 years actually gave you 465% return. Amazon, if you bought it from the first day and held it till today, over 23 years, and you did absolutely nothing, you would have made 137,000%, right? So which means $1. If you invested $1, it would have given you $137,000, right? And hence, why Jeff Bezos is the richest man in the world. Apple over the 39-year period actually grew 86,000%, 86,151. Okay, Netflix as well. They didn't do too bad either from the IPO. They did 36,000%, but this is through 18 years. Okay, Tesla, a bit of a new kid on the block. They've also done very respectably at 3,000%. So that means every $1 you would have gotten back $3,000, or would be worth $3,900 today. This is a 300x or 400x return, right? That means $1 become 400 times bigger. NVIDIA would have given you 24,000, right? So what I did was, on the right hand side here, was actually to equalize over that time period, right? These guys no doubt have done amazingly well in actually generating returns for their shareholders. Amazing, right? But my question here is this, right? It's very easy for me to pull up a slide and talk about this. In fact, I see a lot of people talking about it. But what I want to think about, or what I want you guys to think about, is that number one, to get these kind of returns, you must have first bought it at the IPO. Okay, I think that's easy enough to do. I think most people can do, right? The second part that you need to get these returns is actually have the conviction to hold it for that period of time without doing anything. Okay, and I believe the second part is the most difficult part that nobody can do, right? I think probably only Jeff Bezos, who was the original founder, who may not have sold any shares, actually got this full run up, right? Most investors go in and come out and go in and come out, and I see more often people come in, they make 100% return, they'll be very happy, right? But very, very few people can actually stay the long game. It is not easy. The third thing that will make it even more difficult, you buy, you hold, and then you top up every other year. You keep buying more shares of the same company, right? To get an even better return, right? So although these returns do exist, it's almost mystical, right? That it is within your reach, but yet a lot of people do not do it, okay? Now, the second thing that I want to highlight about IPOs is this, right? You must have picked these stocks. You must have. And here's the thing: 39 years ago, how do you know that Apple will become what they are today, right? They had Steve Jobs initially, then he got kicked out. He didn't do so well. Then they got Steve Jobs back again, and then he revitalized the whole. He basically recreated a whole new ecosystem for them. So if you think about it, it's not that easy, right? And although it's nice and sexy to have these returns, they are not easy within easy reach. Okay. Number two, you must have also, if you have picked one of these stocks, I think you have done really well. But then if you have picked 10 stocks and you pick one of them, which is like this, and you held it, right? Which means that possibly 9 other stocks that you picked may not have done so well either, right? So it is not easy at the point of IPO. You can buy it, but it's not easy to hold through that whole period, right? Just to explain what 𝐶AGR stands for Nelly. 𝐶AGR, short for CAGR, actually stands for compounded annual growth rate. Okay. So typically in investments, we measure our returns that way because it is weighted over time. That means if you say you made 86,000%, but over what time period, right? So for example, if you put your money into FD today and you left it there for 30 years, right, or whatever amount of years, on average, if they pay you 3%, that is your 3% compounded return over that time period. All right. And right, if you think about it, in a sense that most people only look at absolute return without factoring the time, because time is also capital. Called time is also a currency. Okay. Now I got a very good question here from Kwang Seong Lim here. Which stock in Malaysia has a potential return of generating the same return like FANG, right? Now, I think it's almost unfathomable to think, look, US is a great place for innovation. They grow. Most of the big brands come out of US, right? What chance does Malaysia have, right? Investing in Bursa Malaysia. Actually, that's my next slide. Okay, so so the question is how many stocks. Now, what I want to do is let's do it a weighted basis, right? So if you only look at the total return, it's not a fair enough judgment. You must look at the compounded return, right? So compounded return and time, right? So on average, the FANG stocks, maybe I would put it at maybe 15 years if I just did a very simple average, right? And you got the highest CAGR of 44%, but that's on Tesla. And the lowest CAGR of 18% of Apple. But don't forget, 18% over 39 years, it is a very commendable return. Okay, so if you look at the lowest return is 18% compounded. Netflix 18 years is 38%. Tesla is 40%, right? So if you're on just FYI, the long-term return for Buffett over 40 years is actually 20%, right? So I just want to give it, but these are returns excluding dividends. Okay, so I just want to give it just pure share price only. Okay, so let me try and answer that question. If you guys saying, look, if Bursa Malaysia, what chance do we have, right? Now, and that's a funny thing. So when I actually did these slides, I'm thinking, I thought the same, like, only US will have this kind of returns. There's no way Malaysia can get these returns, right? So I show you in a graphical format what they look like, right? So you can download all these slides later, don't worry. But this based on the absolute return. If you look at the CAGR return, this is the kind of CAGR return that we're getting, compounded annual growth rate over time. Okay. Now don't forget Tesla is 44% because only 10 years. All right. Now then let's look at Malaysia, right? So in Malaysia, I tried to pick what is our equivalent of a FANG return, right? What kind of stocks gave you those kind of tremendous returns? Their business grew over time, and they're about maybe 15, 20 years old, not too old, so about the same range. And does Malaysia have stocks that actually give this kind of return? So I'm gonna I know it might be a bit too small, so I'm gonna enlarge all the font to make sure that you guys can see it, right? So I have 5 stocks here actually. Okay, there we go. I actually have a total of 5 stocks here. I think FANG we had 6 there. All right. let's look at the kind of KGAL that we're actually getting. So on average, you can see I've got 14 years, 13 years. Top Glove is probably the oldest at 19 years. Hata at 12, and then Inari at about 9. Okay, so Facebook was only 8 years, so like kind of almost the same in terms of years, of course, I could take out the obvious ones like Public Bank, Maybank, right? But they were listed in 1967, right? I wasn't even born yet, right? Okay. It's easy to pick those stocks, but let's pick the last 20 years and see that if we invested in FANG, right? Like the year 2000 .com bust, if you invested in FANG, you would have made a lot of money. But if you invested around the same period in Malaysian stocks, what kind of return would you be getting, right? Now, I've actually only picked 5. Of course, you can find a lot more, okay? But let's just look at some of the returns, right? So Vitrox actually over 14 years gave you 6,000% return, right? And that actually gave you a KGAL of 81%, right? My EG actually over 13 years gave you about 3,000% return. So $1, RM1 will become 3,000, RM1 will become 6,000, okay? Slightly shorter time because in terms of listing it was slightly different. Also about 83%, right? Because of the 2-year difference. Top Glove was listed in March 2001, so it's almost 20 years. As of Friday, this gave a 33,000 return per compound return. Okay. So you can see kind of, or even Harta Lega gave you 7,400%. Inari at about 9 years gave you 1,756%, right? Actually, all these KGAs are very, very, very highly respectable, right? So if you look at sort of the same time period for more of the sexier stocks that we looked at in overseas, actually, like for like, in terms of pure returns, some of these Malaysian stocks gave you an even higher compound return, right? And they are not exactly very sexy tech stocks, right? Of course, I could have included someone like Nestle, which is very boring. Their returns are also very decent. But I just want to give you an idea. So if you look at back, we're looking at 20% to 40% return. These are easily 5 times bigger, right? In almost the same time period. Of course, I may have missed out a lot more, but I just want to give you guys a sample size, right? And because a lot of people tell me, Malaysia very boring. Let's go look at US, right? Because that's where all the sexy returns are. Actually, if you look at it like for like, the returns that you can find here, of course, there are not many Google, Facebook, Amazon, Apple stocks. There are also not many stocks like this in Malaysia, right? But if you're lucky enough to put one of them 10% in your portfolio and held it for 15 years, you'll be very, very wealthy today, right? And so the whole point here is really, can you understand the business that you're investing in? All right. Now let's look at emerging grade. So emerging grade, so these are stocks from the IPO itself. What I wanted to also highlight is that from the emerging grade side, so let's say they've been running their business for 5 years, they sort of got that thing going, right? And I did 10-year returns, right? So in the last 10 years, again, let me make these numbers a little bit bigger, so for the benefit of everyone. So even when I did a 10-year return, that means June 2020 to June 2010, the compounded returns are still astronomical, right? Even though some of them has actually come down today, they are still very, very exceptional returns, right? So I guess the question here is, do we need to go to a foreign place to get these returns? My answer, I don't believe so. They actually do exist here in Malaysia. Sort of don't. This is based on empirical evidence, right? So don't read everything. Don't believe everything that you read. Okay. Find that empirical evidence for yourself, right? Of course, this is the compounded returns that we've gotten. Now this is the actual returns that we've gotten, right? Of course, the compounded is also in like triple digit, right? In a triple digit case for compounded return is crazy because these are all well over 10 years, right? All at least 10, 15-year-old companies, right? So it's not a fluke, right? So try and look where other people are not looking, all right? Now, when I talk about investment grade returns, right? So I then bring my sights onto what I call investment grade stocks. Investment grade stocks are those companies that have been around for a long time, or commonly known as blue chips, lah, right? They make profits, they pay dividends, they have got cash flow, they've got free cash flow, right? So very stable companies, right? And I sort of picked 5 that sort of came to mind. A lot of people always ask me about Genting share, and I have no reason why I don't invest in it, but it's just not something that I personally invest in. And I also put Genting just to size it up against all these investment grade guys as well. And actually, if you look at this again, let me increase the size so that you guys can see. So comment below if you guys are enjoying this session so far and you find this insightful. Let me increase this. So while I increase, you guys have any questions or comments, I'm happy to answer them. Okay. So, our good ever gold standard public bank that almost every retail investor talks about. How well did they do over the last 10 years? All right. If you look over the last 10 years now, for the sake of investment grade, I've actually included dividend returns as well. Okay. Because typically these companies pay dividends, right? And the investors are attracted to them because they pay dividends. So over this period so far, if you look at public bank, over the 10 years, and they are like the gold standard for investment grade stock, right? Now when I say gold standard, I'm saying in terms of what people perceive it to be, right? They actually gave you a 6% return. So it's only slightly more than your fixed deposit rate, right? Of course, this today where we are, of course, some prices are down, but it's nothing really that fantastic, right? It's nothing you're going to be shouting about. Maybank, on the other hand, is also quite similar. In fact, Maybank gave even more dividends during that same period. But the share price today is the same price as it was 10 years ago. Okay. Also, I'll give you a return of 6%. Nestle, on the other hand, was actually one of the it's one of my favorite stocks. But Nestle is one of those big giants that kind of broke through the common thought process that they will be growing very slowly and it's a very boring stock. Actually, this very super boring stock gave you a 17% compounded return, right? If you have just bought and held it, and they would have returned almost 78% of your original investment over the last 10 years. So it's just a 10-year period. You buy whole, do absolutely nothing, right? And you would have gotten a compounded return of 17%. Now this is also very, very respectable for the risk that you are taking. So this is where I talk about risk-weighted reward, right? In a sense that I'm getting 17% KEGA on a very company that I'm taking very little risk on, right? So this is actually very exceptional returns. So Mohammed Haipal actually asked, what is the difference between compounded and normal return? Compounded, it must look at it over a period of time, right? You can't say, look, I made 100% today. So if you think about it, this stock I bought, I made 100%. That's the absolute return. $1 became $2. But there is a big difference if it took you 1 year to achieve that, 5 years to achieve that, and 10 years to achieve that, right? So in a way, it's a time-weighted return. So if you take 1 year to achieve it, then your compounded return is 100%, right? But if you took $1, $1 became $2 over a 5-year period, then your compounded return is actually 15%. Basically, what it means is that at each point, how much does it compound over time, right? So compounding is, you can go and Google what compounding is, but essentially that's what interest on interest or profits on profits. Okay, that's essentially what it is. Now, FNN also did pretty well, and these are like consumer-based stocks, right? Which you guys have in your household, and they're really giving you some pretty exceptional returns even in times like this. You've got a compounded return of 12%, very, very highly respectable. And I would have thought that banks would have beaten them, but no, actually, these boring consumer stocks have given you these 12% returns. Now, Genting, on the other hand, if you look at it, of all what I call inverted commas blue chip stocks that people love to talk about, this is their 10-year returns. So 2010 till now, I use all the same time frame, right? Of course, they are now in a very exceptional period. But nonetheless, if you look at the dividend payout, it is actually the lowest amongst all of these common blue chip stocks here, right? Of course, today it's in a negative position. You would have lost money if you have bought it over a 10-year period, right? But I just want to give you an idea what investment grade stocks, what kind of returns that you will be looking at, right? So you're going to do with startup IPO stocks. Again, it's easy to buy, but not easy to hold all the way. Does Malaysia have this kind of FANG returns in very short? Yes, we do. Sometimes we try to look outside. Grass is always greener on the other side, right? Okay. And if you look at our investment grade as well, the stocks that most people think have done really well, actually, it's only okay, right? And most people who really like these stocks, actually, some of them have really, really underperformed. So this is on a graphical format, sort of what it looks like, right? Okay. I'm gonna. This is my session. I'm gonna stop here. But I want to give you guys an idea that with the risk that you are taking, there is a reward difference as well. Okay, so you must remember that depending sort of how you weight your risks. Okay, and you shouldn't put all your eggs in just one stock or one basket, they call it. You should actually spread it over a combination of stocks that I've highlighted to you. All right. So I'm gonna pass it on to Peter. Peter's taking the next part, and then we're gonna go to Q&A. All right, Peter, over to you.
Yep. Hi. Okay. My part is more on risk, right? Because we are talking about risk and return. Our Wikipedia definition of risk aside, let's look at how investors really look at risk. For those who have been studying finance or who have some finance background, we will always measure, or they will tell you that risk is this thing called beta, right? In a very short layman's perspective, beta represents the volatility of the share price over the benchmark. Elvin, you can help me to the next slide, which I'll actually explain in more detail. Okay, you look at this chart. This chart actually shows the return of telecom, which is the black line, and of course the FBM KLCI index, which is the red line, right? So in Malaysia, most of the time we are using KLCI as the benchmark, as the representation of the market. Now, if you look at the chart, the telecom chart, which is the black color, compared with KLCI, which is the red color, you'll notice there are some period where telecom share price doesn't move as much as the index, but there are times where it actually moves more than the index. If you look at the period at the far right side, which is around 2017 and 2018 area, if you notice the index only fall by a little, but compared with the telecom, it actually fell substantially, right? So this is what we call as a volatility. Mean to say your movement is much more than the index. So in terms of finance theories, right, they will say if a stock have this kind of characteristic, where the share price is move more than the index, they call that as risky. But if the share price move much lesser than the index, mean to say if the index move 2%, the share price only move 1%. So that means in terms of the finance, the coin is less risky. Now, what was interesting here is if you really look at it in a very fundamental basis, as an investor, you should ask yourself this question: Is share price movement a risk or a real risk? See, at Equities Tracker, we always guide investors, right? When you invest in a share, you actually invest in a business. You should look at your investment at a business perspective. So now, when you start to look at things on a business perspective, what should be the risk that you should be more concerned with? Is it the share price? does the share price a good representation of the company risk, right? And honestly, the answer is no. So back to this telecom example, right? You look at in those 2018 period, where the telecom's price actually plunged much more than the 𝐘𝐨𝐮 index. So under finance theories, they will say that, well, telecom is risky or have a higher risk simply because of share price. If you look at the fundamental of telecom business, it is in the telecommunication business. So will you define a telecommunication business as higher risk or a lower risk? So therefore, what I'm trying to tell investors is that when you start to look at risk, right, don't look at share price per se as what has been promoted by modern finance theories. What you as an investor, you should be more concerned with is what is the business risk. And Elvin, if you can help me with the next slide. So when we talk about business risk, what are the risks investors should be more concerned with, right? Of course, number one, you should look at business perspective. So you should be asking business-related risk. Like for instance, sales. What is the risk to the revenue? Will there be a change in buying habits? Will there be a change in the trends which will affect the company's sales? What are the purchases risks, right? Are the company over-relying on a certain supplier, or there's a multiple supplier to diverse it? What are the risks of the raw materials, right? The supply of raw material costs. What are the risk of labors? Are the company able to actually mitigate, try to solve labor shortage issue? Has the company incorporated automation to reduce reliance on labor? And of course, regulation and so on and so forth. So that's why there's a very big distinction between what, as an investor, you should be worried about in terms of risk, as opposed to what the academics are trying to propose what risk is. On their angle, risk is the volatility of a share price. As an investor perspective, you should be concerned of the risk of a business, right? So if you really think about it, assuming really that the risk of a business is based on the share price. So are you telling me that unlisted companies like Sdn Bhd, which does not have a share price, means they got zero risk? Because there's no share price. So if risk is measured by shares. If I go to my next slide, I think we always hear about high risk, high return. When you talk to anybody, they'll tell you, well, high risk, high return, low risk, low return. So now, but then another perspective is low risk, high return a fairy tale? Is it really impossible to have something that is low risk but high return? Well, I think the answer is actually there is. Like what Elvin mentioned very earlier, what actually is risk, or what actually can consider as risk, is what you know. Okay, let's use this analogy, right? If I were to turn back the clock to when you were 15 years old, right? And you try and be sneaky and you try to drive your father's car out of the porch, right? So 15 years old, you took your father's key without his permission, you try to turn on an engine. Now, what is the probability within the next 30 meters you'll bang something in the front or you bang something at the back? I give you a good 98% chance, right? You are either going to bang something in the front or bang something back in the next 30 meters. Fast forward now, right? If now I have to ask you the question, what are the chances of you, when you drive your car, you're going to bang something in the front and you're going to bang something in the back? Of course, some of you will be very confident and say, no, it's 0%. But let's be more conservative, say, okay, maybe there's only a 2% chance that I will bang something in the front or bang something in the back. Okay, now, what is the difference? The difference is not because so much of the car. The difference is you know how to drive. That's it. So knowledge minimizes risk. So I won't say knowledge eliminates risk. Risk can never be eliminated. Risk can only be minimized. So a low risk, high return situation is really, really possible if you understand or you know what you're investing into. If you know what you're investing into, you have very manageable risk. But if you don't know what you got yourself into, you're absolutely very, very high risk. So low risk, high return is really not a fairy tale. It is something very possible on the premise you know what you're investing into. I think Alvin, that's my last slides. We can actually open it for Q&A.
Yep. So yeah. So now, thanks Peter for reminding me. I'm gonna keep my car keys. When I sleep. Okay. If you guys have any questions, today we left a little bit more time. I know the last session of feedback that we gotten was that you guys wanted a little bit more time for Q&A. We are happy to open this up. If you guys have any questions here, do post it. All right. I got one question here from Facebook, from Kwong Seong Lim. He's asking if, let me see if I can bring this up. Give me a second. Let me bring up some of the comments. Whether you're tuning in for Facebook or YouTube, let me know. Have I missed the boat if I only bought Vitrox, Inari, and my AG a month ago? This is exactly why we say that it's not that easy, right? Because at this point, at any point in time, if you have bought any of these stocks to get those kind of returns, you're never ever going to be 110% sure. So I think what you're asking me is your timing risk high or not, right? Because you bought these companies, I'm assuming that you already understand this business, and you bought it a month ago. So I guess the question is, these stocks have already gone up so much. Can they still go up further, right? And that question can only be answered by you, is how much you understand the business. Yeah. Peter, you got an answer?
My answer. I can only answer you 10 years down the road. If you still remember, you pose this question to me, I will tell whether is it worth buying.
Whether it's missed the boat or not, missed the boat or not.
You need to do your own homework, right? I mean, you say one man's meat is another man's poison, right? So you really have to analyze, invest based on what you're comfortable with. Most importantly, see, you will have the answer whether you have missed the boat. If you understand what is the business about, if you understand what is the going trend for this business, are they still growing? And you understand whether the valuation, are they reasonable within your comfort level or are they not within your comfort level? Actually, all this, if you can answer these three questions, right, you yourself will have the answer whether if you have missed the boat, if you were to borrow it a month ago.
Yeah. Okay, I've got one question here regarding, please explain regarding VAR and Sharpe ratio. Okay. Now, because I don't use these ratios, I did this in university over 15 years ago. I'm going to try and see how I can explain it, because it's almost 15 years ago, before I sat for my exam, I would have known this. But I want to let you know that I don't use any of these. All right. So if you go on Google Sharpe ratio, Peter, you want to cover something?
Yeah, maybe I can give some explanation to that. When I say VAR is actually value at risk, right? It actually represents the. I use the jargon first. Pardon me on that. It is actually represents the maximum loss you can sustain by holding to a financial asset, right? That's called a value at risk. Whereas a Sharpe ratio, remember just now, Alvin presented all the returns, right? But then what happened is Sharpe ratio, they presented a risk-adjusted return. Means they actually count your risk, and then they also take in consideration of the volatility of the share price, then to get a risk-adjusted return. On Sharpe ratio, I already explained just now. See, for Sharpe ratio to work, to calculate Sharpe ratio, you need to count volatility of the share price, which of course your academics take that as your risk, right? As I mentioned earlier, I don't buy the notion that the volatility of share price is a risk. So therefore, no, I'm not a believer of Sharpe ratio and whatnot. This is very simple, right? Academics are not able to measure business risk, or they are not able to quantify business risk. If you ask them, please quantify the risk of losing a supplier, you can't quantify that. So what academicians try to do is they use the next best alternative, something that is quantifiable, right? Which is of course the share price, and they use the only thing that can quantifiable, which is their share price, to represent it as a risk. But I always say this thing, right? In lack of alternative, there is no alternative. If there's a lack of option, honestly, there's no option. By taking the next best share price, which is available data, and use it to measure risk, it is not a representation of risk itself. Then about value at risk, right? Again, it's very academic exercise, right? You're trying to say, okay, if I hold on to this, what is the maximum loss I can withstand? But if you take it on theory, on paper, it looks fantastic. But let's be very realistic. If you invest in the stock and you already expect or have this concern that you will lose money, rather than you take the time to measure your value at risk, might as well you sell the share first, which is a more logical move, right? Rather than you are worrying and you count what is my VAR and hold on to it, hey, look, let's be realistic. Selling off that position is a much easier option than trying to value what is your value at risk. So it must be very realistic. When you're a real-time investor in the market, theories don't really work. Theories looks good on paper, looks good for you to study. But a real-life scenario is much more than what is written in the finance textbook.
Yeah, I agreed. I think you see where Sharpe ratio has factored in is I think they look at the standard deviation of the volatility or on your portfolio return. You see the basis for why they say this is that they're saying that markets are efficient. Okay, that is the basis. Just to give you an idea, right? The theory is that is market is efficient. Whatever is known about the company is reflected in the share price. That is your assumption number one. Therefore, when prices go up and come down, the higher the risk and the lower the risk, right? So if prices don't move a lot, then they say it's generally low risk. If prices move a lot, then they say it's higher risk. I think when some of these theories that actually did come up with it, or actually specifically Harry Markowitz, I think very largely they are talking about very, very large open markets with a lot of liquidity, right? And it may not apply to stocks because Buffett has also always disputed this fact that risk is not price volatility, right? So may not be a good idea to use to use these theories as to measure risk lah. That's also what I'm trying to say. Okay.
There's a very important question from our top fan, Harry Kui. Have Alvin shaved bald?
No, I still got hair.
Oh, okay. You got your answer.
So we're finding an auspicious date.
A shaving ceremony, right?
Yeah, correct.
There's a question from Meili. In unprecedented times like this, what is your advice in managing the risk of our investment?
Can I make this out?
Yeah, maybe I go first. I go first. You see, when I say managing risk of your investment, okay, well, it's something very interesting. You always come across this kind of scenario, right? Especially when you're managing a fund, right? Usually after you manage a portfolio, then people start to question you about this. How do you manage the portfolio of your risk, the risk of your portfolio? But what's interesting is risk, again, you ask very practical question, right? See, risk management comes before you invest in the company. What I mean by that is, when you do all your homework, when you're comfortable with it, you've done all your necessary homework, only when you're comfortable, only you invest in the stock. So risk management comes before you buy into the stock. But when you try to build your portfolio, buy everything you can, buy this, buy that, after you build a portfolio based on rumors, tips, and speculation, and whatever you call it, then only start to think, how do I manage the risk of my portfolio? It's like putting the cart before the horse. So that's why when I build it, okay, portfolio risk management, right? I've been asked this question by investment committees very, very often. But I think what they fail to understand is risk management comes before you buy the stock. Don't go and buy the stock and start to think, what is my risk management?
Yeah. I think maybe from just to add to what Peter's saying, I definitely agree. Before you buy a stock, you go and do your homework first, lah. Basically, don't buy first and then say, "Hey, how right?" I guess the thing is also you may want to, I mean, if you already invested, and assuming that process was not done, have you actually looked at your allocation for each stock or maybe each sector? Just to give you an idea, right? Just to give you an idea. I've seen my students that come out with me when I ask them this question. Actually, number one, they don't know how many stocks they have. Number one, in their portfolio, they have no clue. They just look at me like, huh? Right? Okay. Number two, they actually only can guesstimate the value it is. Okay. Number three, if I ask them what's their top 3 holdings, almost no one can answer me that question, right? Which means that you know very little about your portfolio, right? And that is really the first thing that you want to try and do first. Okay, look at what you have first before you say how do I manage the risk, right? Because that is where you're gonna find clues, right? So I've seen portfolios, one stock 75%. That's not a portfolio, right? That is just one stock. You're praying that one stock will go up. That's it, right? I've seen portfolios where it's 80% cash. What? How to manage risk? You're already 80% cash, right? So look at some of these numbers because they will tell you what you have done, right? And then what you want to do is then find a way to find something you are very comfortable with. Right now, you actually, if you cannot answer those questions, means you don't know what your risk is anyway. So you cannot answer whether you're comfortable or not comfortable. All right, so that's really the first step. Okay. What's the next question?
CK Chang, for
CK
bear
Chang.
market situation, which market instruments would be good for investors looking to make returns? this.
I give you the technical answer first, okay? Yeah, because this is a show sponsored by Bursa Malaysia. I'll give you all the instruments Bursa Malaysia has to offer for bear markets, right? I know they just announced that regulated short selling has been extended till 31st December. So I think just shorting of stocks on the Malaysian market is not possible. However, you can short the index futures, right? If you talk about derivative, that's in the derivative market. If you look at the ETF, I know there is an inverse ETF, which I mentioned earlier. This is a FANG Plus index. Let me just get that number for you. I believe there are two leverage. There are two inverse ETFs that are listed on Bursa Malaysia right now. One is that tracks the FBM KLCI index, and the other one actually tracks the FANG Plus index. So those are the shorting instruments that I would say good, but I'm saying those are the shorting instruments on Bursa Malaysia that are available to you right now. You want to add something, Peter?
I think for buy market situation, which instrument will be good for investors looking to make returns? I think the answer to that is what kind of time horizon, like what Alvin mentioned, the timing risk, what kind of time horizon you're looking at. In a bear market situation, if you are a investor or looking at a longer time frame, let's say 1, 2, or even 3 years perspective, the worst market condition is the best time to buy. When there is fear in the market, when there's blood on the street, when everybody you meet just asks you to sell all equities, right? That's actually the best time to buy equity. But like I said, it really depends on time horizon. If you're not trying to trade and make a quick bucks over the next 1, 2 days, 3 days, there is often other options. But if you're looking for a longer term return, right, definitely the bear market situation is actually the best time for you to invest in equities.
Yep. Bear market instruments. Okay. Okay. So let's look at the next question. Okay. I think there's one question here. From Shamin again, do we need to balance our portfolio and why, when, and how do we need to do it?
For those who have seen my Facebook, there was an interview with the Age, I think a few weeks back, right? And my answer to them is, people usually ask me, am I an active investor or am I a passive investor? Right? Active investor means you trade very frequent. Passive means you buy and do nothing. I think my answer is, I am passive when it's needed and I'm active when it's needed. So I'm the most active when there's a bear market, because in a bear market, it gives you a chance to actually restructure your portfolio by finding or looking at companies which previously you're not able to buy and the price has dropped a lot. It becomes very attractive. When you compare to existing holdings, right, it becomes, hey, this one actually looks much more interesting now compared with what I have. Then I'll actually do a restructure of the portfolio. So actually, I've done that many times in all the market correction. So I was actually extremely active whenever there is a correction or a big correction. But whatever after the correction, right? Basically, I don't do anything because whatever needs to be done has already been done. Then technically, I'll become a very passive investor. I'll just sit and do nothing. So to answer your question, right? For me, I will rebalance my portfolio whenever there is a correction or major correction in the market. I'm talking about those 1-2% every day. But when there's a more than 10% kind of correction, where people become very fearful, that's actually where I will usually rebalance my portfolio.
Yeah.
Alvin, anything to add on the side?
Look, okay, so I maybe Peter's giving you that one side on that correction. Let's say it's down, for example, and we're doing a long portfolio. I think that also applies that when it's going up as well. If you look at certain stocks that have really gone up a lot, and when you first bought it, it was 10% allocation. Now it's maybe 40-50% allocation. You still have to review and look at it. Is it very overly skewed to one or two stocks, for example, and do you want to trim some of them in your portfolio? Right. It's not an easy answer, but I think when you're seeing your portfolio get very, very one lopsided, if suddenly it was let's say it started with 10 stocks very diversified, and then one stock it goes to 50% of your portfolio, right? You may want to relook at your allocation then. Yeah. Just to add to that.
Unless you have a crystal ball where you're 99.9% sure this stock is going to perform.
Yeah. Correct. Okay. So I think there was a question here from there was a comment from Bukhari Samsudin. He says you can short this is what he's mentioned. He said you can short ETFs whose NAV is not accurate to its price. All right. NAV stands for net asset value. All right. Okay. Okay. Let me just sort of explain this portion because I think it's been brought up. It says all inverse ETF in one must have 3 million to be sophisticated, sign, show forms, and show proof. I think they've made an exception now, Florence, that you don't need to be a sophisticated investor to do inverse ETFs. You actually need to watch some videos on Bursa, and as long as you watch the videos on Bursa and you understand and you click and say you understand and you've done that, you can actually then do it, right? If your broker is telling you otherwise, that's not true. I believe when they launched it, they already mentioned, or maybe some brokers may not know, but you don't need to be a sophisticated investor. There are several ways how you can trade inverse ETFs. Yeah, I think they just want to be careful that you know what you're doing. Okay, so this question here: how do I identify stocks like Top Glove, Hata, Inari, MyAG, Vitrox?
Very, very simple. You buy now, you wait for 10 years later to see if they become such. It's you have to really understand the business. Of course, there is an element of I hate to say the word luck, but there's an element for it to succeed. I think very, very recently what has happened was this. Pre-COVID, Airbnb was actually in the midst of doing an IPO, right? And its CEO just came out last 2 days and mentioned that Brian Chesky said that what took them 12 years to build as a business, and they were building a lot of momentum and they're growing their sales and so on and so forth, has been destroyed in 6 weeks, right? And they seriously have to relook at the whole business model, right? Some things are out of your control. So I think as much as you can study the business model today, you can study the management, you can study everything, there is no guarantee they will succeed. So maybe with that little luck, lady chance of lady luck to bring you there. But there's only so much analysis you will know at this point in time or any point in time. You see, okay, another thing, right? If you follow what Alvin mentioned just now earlier in the presentation, right? You see, identifying stock is one thing, but to be able to hold through your conviction throughout the whole cycle is a totally separate matter. Let's take Amazon, for instance, right? You look at Amazon return is fantastic return over the last more than 20 over years, right? But bear in mind, those period covers the famous 2000.com crash in the US. it covered those periods, right? Even companies like your Microsoft suffered during those periods where the share price actually plunged more than 50%. So you may have spotted Amazon then, right? And unfortunately, you may have also sold then. So identifying is only one part of the equation. The other more important part of the equation is, do you have the conviction to believe your analysis and your view and to hold it even through this period? Even our company like Third Wave Hartalega, let's not forget they also had the difficult periods. If you remember in the period 2017, 2018, most of them share price actually fallen more than 30 to 40%.
Correct.
Then you start thinking for growth companies so big, right? Yet when you see them price falling 30, 40%, would you then have the conviction to continue to hold on to it and believe your analysis that this is something I want to hold for the long term?
Yeah, I agree.
Identify is only one part of the equation. Having the conviction to hold on to it is the more important equation.
It's conviction. That's the central question. That's all. How convicted are you? And remember, your conviction is going to be really tested. Maybe the full stop. Your conviction is going to be seriously tested over the time period, right? So imagine if I put it the other way, right? Now Airbnb saying that they might be shutting down, right? Or they've lost a lot. If they were listed, would you still be buying shares today? I don't know. 10 years time could be 10x, right? Example, right? I don't know, right? But have you got that conviction? Like, what information tells you today that with certainty, a high degree of certainty, that their business model will continue on its trajectory and this is only temporary? I don't think you can find any evidence today, to be honest. So it is, maybe I call it inverted commas lady luck, right? Or hunch.
There's a very funny comment from 𝐸_MK. I think if stocks have marriage certificates, everyone will do better. But then again, you forgot about the divorce rate also. I mooted this idea and I thought, but of course no one will like it. But I said you should tax people if they sell stocks early. That will sort of get rid of the whole idea of let's speculate and let's see what happens tomorrow or day after or next week, right? Or 1 month later. But yeah, I think good comment from Yin. Yeah. Okay. I think we're coming sort of close to the end. Let me see if I can answer. Okay, so we've got a long question here. Peter, this is for you. Last time you mentioned tech stocks and some Facebook comments on time.com having good fundamentals. It went up a lot, and I think going forward will still be a good choice. Well, we need to find more good stable stock like this. The truck, and I think it's gonna do really well in the future. It's more of a comment, I think.
Yeah, it's not a question, I think that's not a question. I think that is a comment, right?
Yeah.
This is definitely a question, So I have to remind the viewers that we are on a show sponsored by Bursa, and this is it is a public forum. Unfortunately, we are unable to give you buy, sell, hold recommendations because it will constitute as financial advice, right? So unfortunately, we can't, right? Okay. Maldia.
You remember in MK's comment about marriage and stock certificate?
Yeah.
Then Uber was commenting that it becomes a polygamy because you own multiple stocks at the same
time. Yeah, married a stock. Yeah. Look, I think if there's no more questions, we are sort of 8 minutes to about to close. I hope you guys enjoyed tonight's session. Maybe gave you some insights on thought process. I think investing has got to do with managing your emotions and your psychological mindset towards things. Not something that you can master overnight, but with practice you can, or making a few mistakes. So if there are no more questions, I would like to thank all you guys for tuning in. Don't forget, next week we will be back for the same segment. Before I end, I need to wait. If you guys want to download the slides, give me a moment. Don't go away. Now, so for us to continue to run these sessions, Bursa has actually been sponsoring these sessions. And one of the things that we need all of you guys to help us do, please, right, is please give us comments or feedback on how you like, don't like, you want to see more of, you want to see less of, you want to see any comments you have, right? Can you just guys go to this link here? I need everyone to do us a favor and fill out a evaluation form, because we are being evaluated by Bursa Malaysia to make sure that we are delivering what we're saying that we deliver, which is education. Unfortunately, the comments that you guys put down is not constitute as doesn't count as evaluation form for us. So if we ask all of you guys, who are almost 300, if you guys are tuned in now, do us a favor, click on this link below in the comment section to download the slides. Also to fill up the evaluation form. We would be very, very grateful, and also will allow us to continue to run such sessions. All right. Bursa Malaysia has launched their own Bursa Academy. You can get it at bursaacademy.bursamarketplace.com, right? It's simplified, user-friendly, and accessible anywhere, anytime at your own pace, right? So this is the end for us. Don't forget to give us feedback, evaluate, and after you fill out the form, you actually can download all the slides that we work very hard to prepare for you guys, right? Next Saturday, we have Mr. Benny Lee, who will be back. We will be having a new education segment, also sponsored by Bursa Malaysia, at the same time at 8 p.m. Don't forget to join us. Of course, tomorrow we have our Ask Us Anything Sunday. All right. Peter, you got anything else to add?
Nope. Nothing.
Right. Otherwise, thank you very much for all of you for joining us. We hope to see you guys. Thank you for tuning in. Please share and like or comment, right, on our Facebook, YouTube, whatever it is. Please share this, because these sessions are already sponsored by Bursa Malaysia, and we encourage everyone to make really full use of it. I'll tag your friends on Saturday to make sure. Look, next 7 nights on Bursa, giving you free education, right? Like, comment, and share our posts. All right. Again, thank you very much. If there's nothing else to add, I think we will close up for tonight. Okay, good. All right. Thanks very much, everyone. Bye-bye.
Bye-bye.
Bye-bye.